Good morning, America. Thank you for watching Taxes Made Easy here on the Smart Money Culture.tv. Got a lot of news to cover and got some interesting concepts from politics that have come out recently and things that we're going to cover today to answer that. But main thing, the big questions that we always get is what can the IRS actually do to me? People are afraid of going to jail. They're afraid of facing prison time. So we're really going to hammer home and answer that question today as the main topic for today. So stay tuned, and we'll be right back after this short break. Coming right up again. Welcome back, everybody, and thank you for watching Taxes Made Easy. Again, we're going to dive into the news. There's a lot to cover today. Some good, and it's going to be really kind of our main topic today of what can the government actually do as far as collections actions, what do you need to be worried about. But the first article we're going to touch on is actually a good article, believe it or not. So try to have some good news in there. And this article is from the Epic Times. Target is following Walmart and Aldi's lead to do some massive price cuts. And it looks like Target is really being aggressive here, cutting 2,000 items have already been cut going into the holiday season and looking to discount 10,000 items by the end of the year. Now, so normally I don't shop at Target. It's just not my favorite store, but at the same time, I have when there are really good deals. So now, again, we're seeing inflation is coming down, but that doesn't mean overall prices are coming down. So again, stores are really hungry to get their share, going into the holidays, because this is when stores really recoup their costs throughout the year. So again, 10,000, they said they've already lowered the price on 2,000 items over to 8,000 items discounted this year. And again, they cut prices on 5,000 items in May. So it really goes across the board. So, for example, just Louis fire trucks. I don't have kids that young. But again, they knocked out $5. A Magic Bullet personal blender sets, they cut $10, and there's plenty of other items being cut across the board. 22 Ford GT model set being cut by $25 or $24. And then everyday items as well. Walmart and Aldi have already announced some price cuts, and so again, they're competing here. Aldi being a discount chain. Now, we don't even have Aldi where we are. But it's interesting. There's 25% of U.S. households now shopping at Aldi. I didn't realize that was such a big thing. I forget where I was living, but I have shopped at an Aldi before, but not for years, if not decades. I must have been on the East Coast for a while and shopped at an Aldi, but it's not something I've really seen. But again, both of them have put out ads that they're cutting the price for Thanksgiving and time of the holidays. And so far this year, we have a 2.4%. Well, it was 2.4% inflation in September. It's still going. Inflation is still going, not quite at 2% where we want it to be. The Fed did do a pretty big cut, but we'll see where that goes. But again, I think this is good news that larger companies are cutting prices to try to compete for your holiday dollars. Next article here. This is from the IRS newsroom. And it's interesting as people look at this, you can't just sit back and breathe. Yes, I'm in a disaster area forever to file my tax returns. Some of these deadlines are hitting. So be very aware of this if you did have an extension to help you recover, be aware of when these deadlines are. So this is why it's so important to store your information not only in paper at your house, but also electronically on a cloud or in some kind of format that you can retrieve no matter where you are. When stuff goes south, you want to make sure that you can still file your returns once you get on your feet. So taxpayers in Arkansas, Iowa, Kentucky, Mississippi, New Mexico, Oklahoma, Texas, West Virginia have until November 1st to file the returns. And those are parts of all those areas. So again, just click on whatever state and I'll tell you which counties in those states. And then you have Louisiana, Vermont, Puerto Rico, Virgin Islands, Arizona, Kentucky, Illinois, etc. have until February 3rd to file their 23 returns. So entire states here, but then also parts of Arizona and the rest of these states. And then you have the entire states. This is Alabama, Florida, Georgia, North Carolina, South Carolina, and parts of Tennessee and Virginia have until May 1st due to the recent hurricanes. So make sure you know exactly when your taxes are due, when to hit those deadlines. Again, these are filing deadlines. We talked about this yesterday. Failure to file is the biggest penalty that you get smacked with. So if you don't have information, you've just lost all your information. But you could pull that information from the IRS. So they have all the transcript information, everything that was reported to them. It might be incomplete, but you'll be able to at least get something filed. And if you get more information later, you could always amend your return, fix it, correct it. And if there's no way to get it, just getting a return in will save you on those nasty penalties. So too many people think everything has to be perfect with it to return before they file it. It doesn't. And again, you'll probably lose money by waiting and getting hit with these, missing these deadlines and anything else. So these are, and again, you have the whole page here, disaster relief page. So again, this is just go to irs.gov and just type in disaster areas, and you can click on this. And I've actually shared this to our site. Again, this link will also be on our website or on a link to our show on our YouTube channel. And if you ever need to know how to access it, you can always just give us a call. 520-485-7371 will help you. So, interesting article. Crazy nature of the economy and the news coming out. Yesterday shared an article about how we have more pending home sales than ever before. But if you look, it's all on how you slice it. And so this is from CNBC. September home sales dropped to lowest level since 2010. So we're seeing some improvements in the housing market. And this article says that, yeah, there are some improvements. The forecast moving forward looks good, but it's not all roses. There's still plenty of issues here. Median price of an existing home was $404,500, a 3% increase year over year. Inventory is up 1.5%, which is a good thing. So if you look at pending home sales, looks like it's up, but actual closures is a completely different thing. A lot of people are putting in applications and getting rejected. A lot of people, a lot of sales just don't complete. But hopefully in a month or two, when all the pending home sales close out, these numbers might go up. So previously home sales went down 1%, slowest pace since October 2010, based on the annualized rate of 3.84 million units, 3.5% lower than a year ago. The only area seeing a gain in home sales was the Western region. And so again, they're looking at closings, just when the sale actually happens. And again, they're showing that these sales have been stuck around the same, roughly around 4 million units for the past 12 months. But this is some really good information. One thing they say, I mean, a lot of the articles we share can be kind of Debbie Downers. There's a lot of good news here. So you have inventory rising, and that's 23% higher from September last year. And yet you have distressed properties is minimal because people are making their mortgage rates. Delinquency rates are very low. Distressed property sales were only 2% of all transactions in September. But again, you still have low inventory, so prices are being pushed higher. Cash is still king, but homes are sitting on the market for 28 days on average compared with just 21 years a year ago, which is a good thing. So overall, keep an eye if you're in the market. Talk to a professional. If you need a referral to a good professional, we can help you with that. But we're gonna keep moving forward. In this one time, we're gonna just touch on the war in Israel, or in Gaza specifically. So the war is intensifying again in Gaza. So they're going through northern Gaza. They've already told everybody to leave northern Gaza. So this is when they first attacked. Israel first launched their offensive in northern Gaza to clean out the terrorists that launched the October 7th attacks. They went through and they cleaned out, did a sweep through all of Gaza, then they pulled back. The Hamas fighters just popped up like roaches again, and now they're doing whack-a-mole, but they're going to clean out the north again. So it's going to be interesting to see how do they make this permanent? How do they make this last? So again, they killed the Hamas chief a week ago, but there's still plenty of fighters, and again, things are intensifying. So on the other hand, there's the humanitarian crisis that's being created by war. That's what happens when there's wars. And again, there's a lot of, the health ministry, which is the Gazan health ministry, is hand in hand with Hamas. So this is just propaganda, but they're claiming another 650 people have been killed. Past numbers have been revised, who knows what the real numbers are. And then you have UNRWA saying that one of the staff members were killed. There's plenty of UNRWA staff members that are Hamas. So again, the hospitals have been told to close down and leave, mainly because they're going to clear out these terrorists, and they use hospitals, they use the people as human shields. And so again, it's sad to see, but again, this is what happens when you start a war. This is what happens. These are the consequences of war. So I'm out of time. We're going to be taking a break and coming right back. Welcome back, everybody, and thank you for watching here at Guardian Tax Law. We're going to jump into the next article, and this is from Investors Business Daily. And I pulled this up because it's kind of it doesn't really, tries to give facts. Doesn't really say, hey, this is who we need to support, which is actually really interesting because I think people need good information more than anybody else. If you support Harris, you support Trump, whatever, know what you're supporting. And I had an interesting conversation. I'm coming from in general, I think it's pretty obvious. I come from things from a right-leaning perspective. But again, I'll call out both parties, and we ended up talking about the pros and cons somewhat of both candidates. So going into this, looking at the tax policies of both Harris and Donald Trump, and they kind of go through it very quickly. Their biggest question is, there's no shortage of policy uncertainty for taxes and proposed cuts. Because even though they're proposing all this stuff, what's actually going to get passed is another story altogether. Trump has said, look, we're going to keep the TCJA in place and make sure that those people don't get hit with these taxes. Kamala Harris has said, look, we're going to keep them in place for everybody making $400,000 or less. Problem is, when you soak the rich, where do those costs go? They get passed on, and higher taxes, more expensive services and goods to everybody else, because now they're getting hit and it gets passed on. So there's so many different proposals out there, and one of the big things, changes to the capital gains rate is a big one, from 20 to 28% for higher income earners. You have the elimination on taxes for tip income, and Trump has also proposed ending Social Security benefit taxes. And then there's, both parties have talked about extending child tax credits. So it's like both parties are promising us all kinds of stuff. What's actually going to happen depends more on Congress than the president. The president can propose legislation. He can talk to Congress and work with his party. But again, if you have a split, if you have the Congress belonging to the Republicans and the president belonging to the Democrats, or vice versa, they're not going to get a whole lot done as far as their proposals. So they work together to pass, propose and actually pass legislation with the presidential veto. But the question is, what's going to happen? And again, here's the real key thing. And Waskowitz, from a senior financial advisor at Westcott Financial Advisory Group, says you want to be prepared, you want to be aware, you want to be knowledgeable, but don't be premature in doing things and find out you did it for no reason or potentially hurt yourself. And one of the things, if there are changes, you will have time to make adjustments. Again, depending on who's elected, the TCJA is not expiring until the end of 2025, so the end of next year. But a lot of people are preparing to make moves this year and next once they know what the results of the election are. So one of the biggest things that they're looking at is if the TCJA does expire, the return of higher brackets across the board. So that's largely going to be determined by who's running Congress. And then also you have a cap on mortgage interest and state and local tax deductions. So this hurt homeowners in high tax states more than anything else. Trump has talked about getting rid of that. So, and then there's estate planners are definitely looking at the estate tax exemption. It's currently at $13.61 million. It would revert down to $7 million, and Harris has talked about dropping it to $3.5 million. So that's going to make a huge difference for small businesses. And then a lot of people are looking at if their tax brackets are going to go up, taking those distributions now and converting traditional IRA dollars into Roth IRAs. So you can do it in 2024 and 2025 after the election if those are changing, those are expiring, or the rate is going up, especially for higher income earners. So again, the long-term capital gains assets will rise from 20 to 28% under Harris's proposal. So what are people going to do? They'll take more cash now, which means more immediate money for the IRS, but long-term, less cash when they raise rates. So you're pushing income forward as much as possible. And there are also tax-efficient investments and strategies. Exchange-traded EFTs are still a great option. But it does mean that you need to sit down, talk to experts, and help maximize your portfolio, how to save given the changes. And so when to harvest gains, when to make this done. Sitting down and working with people. It's crazy how I see people. I just sat down with someone last Friday, and at one point they had earned over $1 million and then lost most of it. So if you do have a big gain, don't trust yourself. Sit down with a financial advisor. We've had financial advisors on the show. We've had financial coaches. Invest, plan, pay your taxes, and get ahead. And make your money work for you rather than have, ooh, here's a great boon, and then it's gone. I can't tell you how many times people have come to my office. They had a lot of money and lost it. So don't let that happen to you. Let's prepare and move forward. So I'm going to switch gears a little bit for the last really kind of topic before we move on. There's a lot of articles on this. I just quickly pulled some. And this is about
Litter has now solved
one of the news just came out. Bernie Sanders
around the world.
Hi,
I'm Brad Baxter, founder of Whisker and Litter Robot. You'll
Bernie
never
Sanders
scoop again.
Up corporate greed
always
for
have
inflation
clean
surge.
litter.
I don't apologize for government spending. Ah, boy. Bernie Sanders, our favorite socialist.
With the final stretch of election
and he claims to be a socialist.
Days until election day on November
so,
5th. And the
again, you can look up so many articles. You can go to YouTube. And there's so many different things that show
more on these issues,
or that argue that it's corporate greed that's causing inflation.
It's an honor to have you.
Now, the interesting thing here, I'm going to focus on this real quick. This isn't anything new. Joe Biden, Kamala Harris have all blamed it on corporate greed, corporate greed, corporate greed. This is what's hurting
out
people.
In Michigan and Wisconsin, we have a lot of huge crowds of young people, of trade unionists, so hopefully that's the case. I think, look,
Bernie Sanders is not an economist.
Angry. They're seeing the very richest people in this country becoming richer.
So let's jump to some other people that do know. So one of the things linked here is it's not just Bernie Sanders. It's plenty of other Democrats in power. Senators Warren and Markey, two more left-leaning senators, proposed a bill. This is back in June, that would lead to prison time for corporate greed in healthcare. So they bring out an example again. They're looking at it from their perspective. So again, we don't have the other side here. We have one side of the story. But they said that in Brighton, in Massachusetts, there was some financial mismanagement. Stewards sold the land where its 8 Massachusetts hospitals were located to a real estate investment trust. Then the hospital struggled with massive debt that ultimately forced Stewart into bankruptcy. Hospitals are closing, though. Why? For quite a few reasons. There's more demand, but they're not getting paid the same amount. So under this bill, which hasn't gone anywhere, again, executives would face clawing back all of the money they earn, their any kind of compensation received, and face up to 6 years prison time. If the government decides you looted healthcare entities, if they came back and said, hey, and they would have a 10-year period before or after for the government to decide that if you looted a company or not. So, and there would be civil penalties of 5 times the amount. So again, a lot of teeth here to go after healthcare executives that make decisions the government doesn't agree with. Again, this is pretty scary in my opinion. But the idea is that they're going to employ corporate greed. They're going to go after people and even propose jail time if the government doesn't like what they're doing. So again, this idea that it's corporate greed driving inflation, not the government massively overspending. And here's the thing. Inflation is lower right now, supposedly. And it's lower than last year. But the government's still spending just as much. That's a dirty little truth. We had all the craziness from $3 trillion a year in deficits in 2020 and 21, and now it's caught up to us. But this year we overspent by $1.8 trillion in the fiscal year of 2024, and then the 3 weeks afterwards add another $470 billion in debt. So really, looks like they just shoved a lot of the spending until right after the fiscal deadline, end of the fiscal year, so it wouldn't count. The numbers wouldn't look as bad just before an election. Typical politics. overspending by $2 trillion a year is going to cause the same thing. We have more inflation coming because we're still doing the same things. So again, this idea, Bernie Sanders, that inflation is not the problem, that the government can spend as much as they want. There are plenty of economists on the left that actually argue this. And they've been dead wrong about the economy. It said inflation was transitory, all these things. It hurts you. It robs our children. It robs our grandchildren of their futures and increases costs across the board. And while we can punt and overspend right now as much as we want, it's actually extremely irresponsible. So again, CNN Be It Business goes into this, and this is an article from earlier this year, May 15th of 2024, but I highly recommend you read it. And they also cite research from the Federal Reserve Bank of San Francisco that casts doubt on this greedflation theory, that corporate price gouging was not the primary catalyst for the inflation surge, and we still have much higher prices. And again, they're looking at markups, so charging more than the cost of production. There were a couple of areas, gasoline and cars, more markups spiked, but at the same time, they're trying to, gas is more due to the microchip shortage than anything else. Demand was just really high, and the supply of vehicles was really low due to all the supply disruptions following COVID. Now, again, this inflation crisis was the economy wide. It wasn't just certain areas of the economy, and the Fed economists found little evidence that price gouging was the main culprit. So, again, it mentions Elizabeth Warren here, who for years has argued it's all about corporate greed, attacking corporations. But again, it's looking for scapegoats and using political language to obfuscate, to distract what's really happening in the economy. So do your own research to see, make your own decisions. What's really going on here? I guess I didn't share this time. So again, here's the CNN article. I highly recommend you read through it, ponder it. Again, this is straight from the Federal Reserve Bank of San Francisco, where these numbers and analysis is coming from. So from the government itself, which is countering what the politicians are saying and what they're proposing and the proposed recommendations, which, in my opinion, would just make the issue worse. So changing gears, we're going to go to the main topic for today. And again, these are some of the main questions that I get from people. The biggest concerns I get from people are, what can the IRS do to me? How much trouble am I in when I owe taxes and when I haven't filed for years? Again, it's really important to sit down, understand what your rights are and the consequences of owing taxes. Do people go to jail? Yes. Is it common? Absolutely not. So I want to focus real quick on when do people go to jail. And we've had this conversation before, but I just want to kind of highlight it and break it down a little bit more. When you lie, when you hide assets, when, again, it's not just not filing your tax returns. It's when you take active actions to hide those assets. When you're reporting false income on tax returns, or using shell corporations, or using foreign assets to try to hide funds, that's when you get in trouble with the IRS and state tax agencies. If you're collecting sales tax and spending that, again, sales taxes is definitely something that states are very aggressive about collecting. So be very wary about not paying sales tax. Most people, 99.9% of people that have tax debt are in danger of going to jail, having the sheriffs come out and arrest them or anything like that. Can it happen? Yes, but that's when you do everything wrong. So one of the big things I tell people is put the shovel down. Let's get straight with your taxes. Let's get straight with the IRS and the state, whatever state taxes you owe, and let's be proactive and start improving the situation. And you'd be surprised how much that can just take that burden off your shoulders and let you breathe easy. And that's one of the huge things that, that's one of my big whys as to what we do, why we do what we do, is helping people be able to breathe easy, sleep again, and also know that their taxes are being handled, are being addressed. So what are the typical collection actions that the IRS can take? First one, bank levies. And a lot of people that have owed taxes or have unfiled tax returns for multiple years, that's the IRS hits your bank account. Now, when they hit your bank account, is that the end of it? No. You have an opportunity to contest it. So as soon as that happens, you need to be in contact with the IRS or the state, either yourself or through a representative, to try to get that reversed. Because whenever that levy hits, legally, and this is part of due process, you have so many days to get that levy reversed. It's 21 days with the IRS, and those are calendar days. And with most states, it can vary. It can be 2 weeks, it can be 10 business days, which normally turns out to be the same. Sometimes it's less, 10 days. It really depends on the state. So as soon as that levy hits your bank account, you need to be on the phone. You need to be figuring it out. You could qualify to get that money back and get it released, but if you wait past those deadlines, the money, most of the time it's gone. Once they actually send the money to the IRS or states, that money's gone unless you can prove it was never your money to start with. So, and that's, again, much harder to do once the money is gone. It goes into their coffers and much harder to get it back. Much easier to be proactive about it. The second thing is garnishing wages. And we're going to slow down and kind of break these down for you as well. But the IRS can issue garnishments on wages, on income, on Social Security. Yes, they can garnish Social Security. And the key thing about Social Security is they're limited on how much they can take. I believe it's 15%, but it can still hurt, and hurt quite a bit when you're on a fixed income. It takes longer, especially with Social Security, to release those garnishments, but it can be done. And we release wage garnishments all the time with the IRS and the states. You just have to, the longer you wait, the more the damage happens and the harder it is. So we'll be right back after this break. Welcome back, everybody. And so just doing a quick recap, but what I really want to focus on are what are the difference between bank levies, wage garnishments, and liens. So liens can be a very general term that people get confused with all the time. So they think of bank levies, garnishments, and tax liens as one and the same. When you're dealing with the IRS and usually with the states, they typically use similar language. So they can call a bank levy a garnishment or a wage levy instead of a wage garnishment. They can mix up some of the terms. But a tax lien has pretty consistent information or consistent meaning. Why? Because it has the same application across the board. So bank levies, wage garnishments, they're going out and grabbing your money either from bank accounts or from your regular pay. So that could be a 1099, that could be a wage garnishment. So if you think, hey, I'm self-employed, I don't have to worry about that. If you have a bank account, which you should, it makes it a lot harder to run and manage a business. But also they can levy your vendors, whoever's paying you, unless it's small. And if you're just dealing with individuals where it's small transactions, they can actually hit any merchant processing. So yes, you can survive and get by on the margins, but to really truly thrive, I highly recommend dealing with this head on, addressing the situation so that you can live your life to the fullest without trying to dodge the IRS, living in the shadows. And we see people doing exactly that, and again, it's a tough life. Life doesn't have to be that hard. So what is a tax lien? And this gets into, explaining what is a lien. So people can put liens on property. You might have a contractor's lien if someone comes and installs an AC unit, and you do, or you can get a loan to have that put on there, and it gets attached to your mortgage. Anything that's attached to the house or has anything to do with your mortgage, they're going to put a lien on it to make sure they get reimbursed for it. So if a contractor comes and works on your home, builds out an addition, and you have to pay them over time, they'll put a lien on your home to make sure that they get paid. Now, one of the interesting things is the government does this all the time as well. If you owe the government, they can go and put a lien on any real property that you owe, and they do this through the county recorder's office. Now, liens can also be put on vehicles, but what the government really does is just limited to real property. Most cars aren't worth enough to try to put a lien on it. It's not their normal mode of operation, so they don't do it. Just pretty much hands off. If they're going to go after a vehicle, they're going to come and actually seize it and sell it at auction. Happens very rarely. They do it when people do everything wrong with the IRS or state taxes. The scariest thing I've seen is someone that had a car lot, was blowing out the IRS, playing funny games with them. You had all these cars. And he annoyed the IRS to the point that they came and were ready to seize all the cars in the car lot. Not a smart way to go. Anyway, so liens are attached to real property. People wonder all the time, what about my mortgage? Because most people don't have real property that they own free and clear. So the way this works, and this is really where I want to spend the meat of this time, is explaining this. Under law, you have what's called a purchase money order lien. So it's what you use to purchase a property or an item. And so when someone sells something to you and there's a loan on it, like a vehicle lien, furniture liens, etc., but especially for real property, most people, like I said, they're not going to just buying property with cash. They're using loans to purchase property. That loan that you used to purchase the property has first priority, because the sale wouldn't have happened otherwise without that lien. So if you don't pay the loan, the bank, whoever owns that mortgage, can foreclose on the property and get that money back. Why is that? And why does it have such high priority? Because banks and people wouldn't loan the money for people to buy homes. It would really slow down the housing market. It would cause a lot of problems if lenders couldn't have a guarantee that, yes, if I'm giving them the money to purchase property, that I have some recourse, I'll be able to get my property back. So that's why it's usually the bank or the company, whoever owns the loan on a vehicle, that's repossessing the vehicle. So again, it just to explain that concept real quick. So that's why when you have a home and you have a mortgage on it, the IRS tax lien always comes secondary to a mortgage. Now, the rest of it is kind of first in line, first come, first serve. So if you have someone puts a lien on the home, so let's say you build a home, you have a mortgage on the home, but then you have a dispute with the contractor, and the contractor slaps a lien on your home. If you ever sell the property, refinance it, etc., that contractor will get paid before you get any profit. So essentially, the mortgage will get paid first, then the contractor's lien, and whatever's left over is profit to you. And this is after the normal expenses to your realtor, buying and selling house, all that. So let's say you have a mortgage, then you have a contractor's lien, and then you get a tax lien, an IRS tax lien. Who gets paid first? The mortgage, then the contractor, and then the IRS. It's in order of priority based on who filed the lien first. So the IRS doesn't get to jump the line when it comes to liens on property just because it's the IRS or the state. So they come in order when a property is sold. So if you sell a property below value, or you pay off the mortgage, you pay off the other liens, and there's nothing left for the IRS doesn't get anything. Same with the state. So it's just a normal lien, and it's filed with the county recorder's office. How do you know if a tax lien is attached to your property? You can pull your transcripts, but better yet, you check with the local county recorder's office. There are times the IRS files tax liens, and they normally file it where you reside, but if you have property that's not in the county, that's elsewhere in the state, etc., there are times that the IRS fails to file their lien in the correct county for that property, and the lien doesn't attach. We've got a big case right now that we're looking at where they filed it on one house, but not the other house, because they had one house where their main residence was, and then they had another house on the other side of the country. Second house doesn't have a lien. So it's important to know that when you're checking for information, when you're looking at what's going on, it is very valuable to have good information about, is it lien even attached to my property? Now, sorry if you see a chair moving around, I've got a dog in here and he's feeling a little sick. So he's just hanging out here, but he's hanging with me. So as far as where is the lien filed, it makes a big difference. When is the lien filed? And this is one of the big questions that we get. First of all, it's usually filed, it can be filed anytime. When you owe taxes, the state or the IRS can file a lien pretty much anytime that there's a balance. But when do they normally file a lien? When it goes into collections, when there's not a resolution on the case, especially when, if you go to set up an installment agreement, there are a few installment agreements where the lien is exempted. If it's payroll taxes, it's $25,000. If it's normal taxes, any other kinds of taxes, if it's under $50,000, if it's normal income taxes, you can set up what's called a direct debit installment agreement and avoid the filing of a lien. So it's important to understand, when is a lien going to be filed? So let's say you owe $60,000 and you want to avoid a lien. You can pay the balance down to $50,000, and this is assessed balance. Then set up an installment agreement. You just have to make sure you do it the right way. And if you do it the right way, you'll avoid a lien filing on your property. Now, when does a lien actually go into effect? When does it actually trigger? Again, when you sell the property, you try to change the title on the property, or you're refinancing it. So any of those three circumstances, if you don't do anything with it and the lien just sits there, I mean, it's not reported to the public, shouldn't affect your credit. Since 2017, they changed that. And eventually the debt will go away. And if it sits there long enough, depending on when the expiration dates are on the debt. So just because a lien is filed, it's not the end of the world. If you're in a hardship status and you just can't afford to pay the IRS, you can stop all collection activity by going in and getting a hardship status approved on your case, or currently not collectible. But that will trigger a lien. Anytime you're telling them, look, I can't afford to pay you, a lien will be filed if one hasn't already been filed. If you go and you do an installment agreement to only pay us a percentage, a small amount of the total balance, a lien will be filed. If you do an installment agreement over $50,000 owed, they will file a lien. So a lot of times when you are setting up a resolution, that will trigger the filing of a tax lien. Is it the end of the world? No. But for some people in their industries, or if they're self-employed, it can be a problem if they're regularly out getting loans for their business, if they're negotiating. But believe it or not, it's not the end of the world. So a lot of people are concerned about purchasing a home. They want to get in the housing market, and they want to purchase a home. They want to get in the housing market, and they want to be able to purchase a home for the first time you can do it with tax liens. So believe it or not, and we do this regularly for people, where we go in and we'll negotiate an installment agreement. Tax liens will be filed, but then we get them to qualify for, and once we put them in an installment agreement, there are plenty of mortgage companies that will let you purchase a home with tax liens. They just need to show that you're on an installment agreement. Sometimes they insist that there's 2 or 3 payments on that installment agreement before they approve you for a mortgage with a tax lien. Happens all the time. You just need to know how to work with it. So the last thing I want to touch on is how to get rid of tax liens. So once you pay it down below $25,000 with the IRS, you can get a tax lien removed. It's always easier to stop the filing of a lien in the first place. But you can get it removed through, you pay it down below $25,000. If they see consistent payments, you can request and petition that it be removed. When you first get the notice that a tax lien is going to be filed, that there are appeal rights, it is very hard to get a lien removed. Once they've sent those notices, look, a lien has been filed, you have so many days to contest it. Essentially would have to cost you the loss of your job, the closure of your company. You need to have some pretty strong details. And even then with some of those arguments, I've seen the IRS just say, we're going to do it anyway. The IRS has been less responsive, less willing to work with people than in the past, and it's been a concern. So, when you have a tax issue, it's always better to get ahead of it, to deal with it. So if you pay the balance off, if you get it below $25,000, you do a successful offer and compromise. Then you can get that taken care of. And once that balance is wiped out and addressed, then you can go in and remove those tax liens. And they should be self-releasing after 6 to 8 weeks after an offer is completed or the balance is paid. And if it doesn't, we can go in there and petition for the tax lien unit to remove those. One of the big concerns that people have is I'm trying to sell a property with a tax lien. Can I sell it even though there's a tax lien? Absolutely. And the IRS actually is fairly responsive on this because they want you to sell property. Why is that? When you buy, sell, transfer property, they're more likely to get paid. So they're usually on it. They'll work with you and make sure that you get this taken care of. So when you're buying, selling, refinancing, there's a few things called lien subordinations, lien subrogations, where you can petition, say, hey, I'm trying to sell this property. The IRS either get paid in full or in part, but we want to sell the property, and they'll do that, and they'll work with you as long as the IRS is still getting something. But even if they're not, if you're selling a property and the IRS isn't going to get anything because there's no profit to be had, you can still work with them to get that property sold and get this taken care of. So, this is my main goal today, to really talk about tax liens, how they affect you, what are they. And one of the last things I want to mention here is, and this is something more and more people are seeing, passport suspensions. Like, and it's one of those things, if you owe, I believe it's $50,000 as a threshold. If you owe over a certain amount, you can have your passport, your taxes certified delinquent. And once that's certified delinquent by the IRS, that information is sent over to the State Department, and your passport will be suspended. Now, is that the end of the world? No. Too many people, though, when they owe taxes, they'll go in, they'll try to fly, and then all of a sudden they're in the airport, tickets in hand, and they told them your passport's suspended. You can't fly today. You have to go get that fixed. It takes months to fix it. We have to put a resolution in place. It can be a hardship status, can be an installment agreement. Something needs to be put in place. And then it'll take 45 to 60 days to get that passport suspension released. So call us if you have any questions, and we will see you tomorrow.